This presentation is called The Other Side of Monetary Policy, Money Supply. What this means is that we're going to look at what we call the other half of monetary policy. We normally talk about monetary policy as consisting of two things: the control of interest rates and the control of money supply. Now, we've already looked at how interest rates can affect economic activity. So if we're worried that GDP is slowing down, GDP growth rate is slowing down, or that we're in a recession where GDP is actually falling, we want to increase GDP. So we apply what's called expansionary monetary policy. But effectively what that means is changing the bank rate downwards. And if we're worried about inflation, we apply what's called contractionary monetary policy. But what does that mean? That means increasing the bank rate. So far we've only been talking about changing the interest rate that the central bank charges to commercial banks, which is called the bank rate. But we know that there's another side to monetary policy, which is control of the money supply. So this presentation is going to look at what part the money supply plays, if any, in monetary policy, and what's it really used to achieve. Okay. What we have to understand is, when we talk about monetary policy, although we understand that it has two parts, the largest part of monetary policy is concerned with altering the bank rate, up or down. So changing the bank rate is the biggest part of monetary policy. You could even say it's 90% of monetary policy is to do with what we do to the bank rate. Do we move it up? Do we move it down? Etc. That doesn't leave much room for money supply. And in fact, that's just as well, because money supply is not used actively as a way of influencing GDP. So although controlling the money supply, changing it up or changing it down, is potentially a part of monetary policy, and it is a part of monetary policy, it is not used to influence the GDP of the country. So let's look at how we could use money supply to affect GDP if we wanted to. Let's see how we could use it if we wanted to. If inflation was accelerating in an economy, and the central bank was really worried about that, what it could do is reduce the money supply, and we'll see how to do that in a later presentation, but it could do that. Now that would mean there was less money circulating in the economy. And what effect would that have? With less money in the economy, there would be less money to borrow. Now when there's less of anything, its price usually goes up. And that's exactly what would happen here. If there was less money to borrow, the cost of borrowing, which is the interest rate, would rise. So therefore, what we can say is that changing the money supply can change interest rates. If we reduce the money supply, we can cause interest rates to go up. So if the central bank wanted to do this, it could. There are ways it could reduce the money supply and therefore cause the interest rate to rise. But when the central bank really wants to change the interest rate, it does not do it via the money supply. So although this is theoretically possible, it does not mess around with the money supply when it wants to change the interest rate. Instead, it changes the bank rate directly, which is entirely within the direct control of the central bank. So the message is, when the central bank wants to change interest rates, it could potentially do it in two ways. It could change the bank rate, which is the interest rate it charges to commercial banks when they borrow money from the central bank, or it could change the money supply. It chooses to do the former, the first one. It changes the bank rate. It does not use the money supply. So money supply in the economy is only adjusted to rise as GDP rises. We have to do this because as the GDP rises, the economy is producing more output. So we have to make sure that there is enough money in the economy to buy the output that we are producing. And this is what the central bank does. It makes sure that there is enough money in the economy and that the money supply is rising as GDP rises. This is how it uses money supply, not to influence the interest rate, but just to make sure that the growth in money supply matches the growth in the output of the economy. The central bank does not decrease the money supply deliberately in order to force interest rates to go up. This is not the way it uses money supply. So therefore, what we have learned is that monetary policy does indeed have two parts. One part involves the control of interest rates via the bank rate. The other part involves the control of the money supply. The central bank can do both. It can control interest rates via the bank rate directly, or it can change the money supply, which will have an effect on interest rates. But when it wants to change interest rates in the economy, it focuses on controlling them directly. It does not use the money supply in order to change interest rates. Of course, the only time that it does change the money supply is not when it wants to change interest rates, but when it wants to make sure that there is enough money available in the economy for the output of the economy to be easily bought and sold. So as GDP goes up, money supply is increased by the central bank, but only for this reason, not in order to influence interest rates.